Welcome to the deep dive. Today, we're taking a look ahead, really diving into the potential investment landscape for 2025.
Yeah, it feels like a year many people are watching closely.
Definitely. Big shifts potentially coming in, well, both crypto and traditional finance.
Exactly. And we've pulled together some pretty interesting perspectives for this. We'll be looking at Blue Chip's playbook for crypto, specifically their call on a big alt season.
Right.
Then Craig Basinger from Purpose Investments, he's got a view on the next bull market in traditional assets, arguing it'll look, well, quite different.
Different how? We'll get into that.
We will. Plus, we've got Y charts giving us some historical context on the current bull run, and Sapiens Alpha on the technical side for Bitcoin, focusing on that key bull market support band.
Okay, so our mission here is, to pull out the key insights from all this for you, connect some dots, maybe spot some opportunities, but without, drowning everyone in data.
Sounds good. Let's start with crypto then. Those 2025 predictions are pretty eye-catching.
Yeah, Blue Chip on Binance Square is predicting a full-blown alt season starting spring 2025. What's that based on?
Well, it seems to be heavily based on historical patterns. The idea is after Bitcoin has a big run-up and then kind of consolidates, its dominance tends to fall off.
Right, Bitcoin dominance. That's Bitcoin's market cap compared to the whole crypto market cap, essentially.
Exactly, like
Yeah.
its slice of the total crypto pie. If Bitcoin's slice shrinks, it means the other slices, the altcoins, are growing, relatively speaking.
So less dominance means more capital flowing into alts.
Precisely. Blue Chip uses 2021 as the main example. Bitcoin dominance fell hard then, right? From about 73% down to around 40%.
Wow, yeah. And that's when we saw huge gains in things like Solana, Cardano,
hmm
even Doge.
Exactly. So Blue Chip notes that dominance is kind of hovering around 55% now, which they see as a resistance level.
So the thinking is if that level breaks down,
Well, we could see a similar flood of capital out of Bitcoin and into alts, maybe pushing dominance back towards that 40% mark again.
it's interesting that market psychology, once Bitcoin settles, people start looking for the next big thing, the higher risk, higher reward plays.
It's that grass is greener effect,
Yeah.
absolutely. Understanding that cycle is almost as important as the charts.
So what does Blue Chip think will actually trigger this? What are the catalysts?
They mention a few things. One is just growing adoption generally, more people, more institutions getting into crypto.
Makes sense.
Another one they mention, which is, well, interesting, is the idea of Donald Trump being a potential crypto president. They seem to think that could boost confidence, maybe bring some regulatory clarity, at least how they see it.
Okay, that's definitely a factor some are watching. And what else?
And then narratives, specific stories or themes taking hold within crypto.
Right, like certain sectors getting hot, AI, gaming, that sort of thing.
You got it. It's like the market focuses on a particular story. Blue Chip actually lists out some key narratives they expect to be big in 2025 and some example tokens for each.
Glad to hear them.
Okay, first, AI artificial intelligence. They list Render, Teo, Grass, IO, Spec, GRT.
Lots of buzz around AI everywhere.
For sure. Then, AI agents, sort of automated programs doing tasks on chain. Tokens like Virtuals, Luna, that's a different Luna, by the way, AIXBT, Griffin, Hat, AI16Z.
Okay, crypto meaning cutting edge tech. Makes sense. What's next?
Well, can't ignore meme coins. They include PP, Popcat, Fartcoin, MOG, GGA, WIFE. High risk, high volatility, but, sometimes huge gains.
The wild side of crypto.
Definitely. Then real-world assets RWA, tokenizing things like real estate or bonds on the blockchain. They mention Ondo, OM, Polyx, Zpool, Trade, PRCL.
That's a fascinating area, bridging traditional finance and crypto.
It really is. They also highlight DePIN decentralized physical infrastructure networks, using blockchain for real-world infrastructure like wireless networks.
Yeah.
Think HNT, Mobile, AKT, Theta, AR, IOTX.
Interesting. More tangible applications.
Yeah. And DESI decentralized science, using crypto for research funding, data sharing. Trod, Vita, RSC, AXGT, HARE, RJV are examples there.
Wow, okay.
And of course, the core stuff, DeFi and infrastructure. Tokens like Eigen, Hypeseat, Zero, Ine, AAVE, Pendle. And finally, gaming play to earn, metaverse stuff, CAH, Crown, Prime, Shrap, Pengyu, ALV.
That's quite a list. It really paints a picture of where the innovation, or at least the hype, might be focused. So the takeaway for you, the listener, is maybe get familiar with these areas.
That seems to be the suggestion. But, and this is crucial, Blue Chip really hammers home the need for a profit-taking strategy.
Right. It's not just about picking winners. It's about knowing when to sell. What's their approach?
It's a fairly standard tiered approach. They suggest selling 33% of your position when it hits 3x your initial investment. That gets your original capital back.
Okay, de-risking early.
Exactly. Then sell another 20% at 4x and another 30% at 5x.
So you're locking in profits progressively.
Right. And what's left, maybe 5–10%, that's your moon bag. You let that ride for those potentially crazy unexpected gains.
Sensible. Prevents getting too greedy and trying to time the absolute top, which is, well, nearly impossible.
Precisely. It's about discipline.
And Blue Chip connects this all back to the Bitcoin halving cycle too, right? Like the 2020 halving leading into the 2021 bull run.
Yeah, they see a potential parallel, suggesting this could be part of a cycle that maybe sees Bitcoin hit, $200 or more, which would then really fuel those alt explosions.
Okay, and they even have stages for navigating this alt season based on Bitcoin dominance. Can you break that down?
Sure. So stage 1, Bitcoin dominance peaks, starts to fall. Maybe ETH and BNB start outperforming Bitcoin. Blue Chip says this is when you start buying those high cap alts.
Get in on the leaders first. Makes sense. Stage 2.
Stage 2, those high caps gain momentum, more retail comes in. Now, Blue Chip suggests adding some mid caps, but focus on those strong narratives, AI, RWA, DePIN, etc.
Okay, branching out a bit as confidence grows. Stage 3.
Stage 3, mid caps start really popping off, maybe exponential gains, hype builds. Here, they say start taking some profits on those mid caps and begin looking at low caps. Smaller projects, higher risk, but potential big movers.
Right, moving further out on the risk curve, stage 4 must be peak mania.
Pretty much. Stage 4, low caps go parabolic, things get irrational, FOMO is everywhere. Blue Chip's advice here is take profits aggressively. Lock it in across the board, but maybe still hold that tiny moon bag just in case.
And the final stage, stage 5.
Stage 5, market exhaustion. Prices flatten or drop. Liquidity starts moving back to Bitcoin or stable coins. The party's winding down. Blue Chip says exit your remaining alts, move to BTC or cash. Secure the gains.
A very structured way to think about a potentially chaotic market phase.
Definitely needs structure. Now, shifting gears slightly, but staying with crypto for a moment, Sapiens Alpha, they're focused on Bitcoin's technicals, specifically this bull market support band. What is that exactly?
Right, the bull market support band. It's basically a combination of two moving averages on the weekly chart, the 20-week simple moving average, SMA, and the 21-week exponential moving average, EMA.
Okay, moving averages just smooth out price action, right? Help see the trend.
Exactly. And Sapiens Alpha argues this specific band, the 20 SMA and 21 EMA, has historically been a really key level for Bitcoin. Kind of the line between staying bullish or risking a bigger correction.
So how does Bitcoin's price relative to this band give us clues?
Well, historically, according to Sapiens Alpha, if Bitcoin falls below the band, but then manages to get back above it and stay above it, hold it as support, that's often been a trigger for major upside moves, like new all-time highs kind of moves.
But just poking above isn't enough. It needs to stick.
Yeah, they stress that. Sustained price action above the band is what matters. Confirmation over weeks, not just a quick jump.
Why those specific averages, the 20 and 21 week? Is there a reason those are popular?
It's a good question. They are quite widely watched by longer-term traders. The 20-week gives you roughly the average price over the last 4 or 5 months. The 21-week EMA reacts a bit quicker because it weights recent prices more heavily.
So holding above suggests the medium to longer-term trend is still up.
That's the idea. It shows those key averages are acting as a floor as support. Falling below, and especially staying below, signals a potential momentum shift downwards.
So what are they watching right now, Sapiens Alpha? What levels matter?
They're saying if Bitcoin can close the coming weeks above that 20-week SMA, it really strengthens the argument that the recent pullback might be over, that the uptrend is resuming.
And the downside risk?
A weekly close below the 21-week EMA. That would be a warning sign, increasing the chances Bitcoin could make a lower low, potentially following some less positive patterns from past cycles.
Okay, clear technical levels to watch. They also mentioned the macro picture, didn't they? Quantitative tightening, or QT. Can you unpack that quickly? Why is it a headwind?
Sure. QT, quantitative tightening, is basically the opposite of QE, or quantitative easing. With QE, central banks pump money in by buying bonds. With QT, they're effectively pulling money out, letting bonds mature or selling them.
So less money sloshing around in the system.
Exactly. It tends to push interest rates up, makes borrowing more expensive, and generally acts like a drag on asset prices, stocks, crypto, you name it. Sapiens Alpha suggests that until central banks pause QT or pivot back towards easing, market confidence might remain a bit shaky. The market's kind of waiting for that green light from policymakers.
Waiting for the tide to turn on liquidity. Got it. And they looked at history too. May July performance after Bitcoin halvings?
Yeah, they did. Historically, May and June can be slower, the crypto summer lull idea. But in the years after a halving, like 2013, 2017, 2020, there's been a tendency for potential strength during that May-July period.
Ah, but there's a catch.
There is. Sapiens Alpha points out this historical upside only really happened after Bitcoin got back above those key moving averages, that bull market support band.
So the technicals have to confirm it first. History isn't a guarantee.
Exactly. History provides context, but the current charts and that support band are critical signals right now.
Okay, super interesting. Now let's completely switch tracks. Traditional finance, Craig Basinger at Purpose Investments, and white shirts. Basinger thinks the next bull market looks different.
Yeah, very different. He argues the last big bull run, the one after the 2008 crisis, was really fueled by unique conditions. Disinflation, super low interest rates, globalization picking up steam. That allowed central banks to just flood the system with QE.
Right, the era of easy money.
Exactly. Basinger thinks the next cycle flips that script. He sees a shift from QE to QT, less globalization, maybe more isolationism, and importantly, moving from disinflation to an environment with higher and maybe more volatile inflation.
Wow, that's a fundamental change in the weather, basically. What does that mean for central banks, then? Can they still just open the taps?
Probably not as easily, according to Basinger. If inflation is stickier and more volatile, central banks have less room to stimulate aggressively without just making inflation worse.
So the punch bowl they talk about, it's smaller this time.
Much smaller, potentially. That's the argument.
And what about borrowing costs? The last decade was defined by cheap money.
Basinger sees that ending too, a higher cost of capital overall, which means companies can't rely as much on cheap debt for things like share buybacks or M&A to juice their performance.
So if financial engineering is less effective, where does stock growth come from?
Real business performance, basically. Actual earnings growth, better revenues, efficiency gains, not just shuffling money around. He also thinks higher bond yields could act as a bit of a cap on stock valuations. So companies will really need to deliver strong earnings to push their stock prices up.
Okay, so fundamentals matter more. What kinds of stocks or factors does he think will do well in that kind of environment? Sounds like maybe not the same leaders as last time.
Exactly. He's anticipating a shift. He favors value stocks, companies that look cheap based on their fundamentals, over the high-flying growth stocks.
Interesting.
He also suggests smaller companies or equal-weighted strategies might do better than just piling into the mega caps. And dividend-paying companies, especially those with less debt, could be attractive.
Why those specifically?
The thinking is they're generally less sensitive to rising interest rates and might hold up better if inflation is higher or the economy's a bit bumpier, more resilient perhaps.
Makes sense. What about currencies? He mentioned the US dollar.
Yeah, he thinks the dollar, after being strong for so long, might be near a peak. He sees potential value in currencies like the Canadian dollar, the euro, the yen,
So look outside the US.
and diversify geographically in general. He suggests international stocks might actually outperform U.S. stocks in the next cycle, which would be a big change from the last 10 years or so.
Definitely a contrarian view compared to recent history. Now, Y Charts chimed in too. They noted the market technically entered a new bull phase in 2023.
Yeah, they pointed out that we officially left the bear market behind last year. And they added some historical context. Since 1950, the average bull market in the U.S. has lasted about 5.38 years.
An average, of course. Some much longer, some shorter.
Right, it just gives you a very rough time frame, but every cycle is different, past performance, etc.
Understood. What sectors did Y Charts see leading this current bull market in its early stages?
Well, no surprise here, maybe. Technology, massively boosted by all the AI excitement.
AI again, it's everywhere.
It really is. They also mentioned communication services and consumer discretionary doing well, and specifically called out the strength of the Magnificent Seven tech stocks, and especially NVIDIA's incredible run.
So tech dominance, largely fueled by AI, has been the story so far.
Seems like it. White Charts also had some advice for financial advisors, right?
Yeah, mainly about engaging with clients during a bull market. They see it as a good time to connect, maybe bring in new clients who are feeling more optimistic, and crucially, talk to existing clients about the risk of staying too conservative, like sitting in cash or money markets, when equities are potentially offering much better returns.
The opportunity cost argument. Don't miss out.
Exactly. Help clients participate appropriately.
Okay, so let's try and tie this together. We have Blue Chip forecasting a potential crypto alt season in 2025, driven by narratives and Bitcoin dominance shifts.
We have Sapiens Alpha giving us key technical levels for Bitcoin, which could dictate the mood for all of crypto.
Then we have Basinger and Y-charts talking about a new but different traditional bull market maybe taking hold, with shifts in leadership and macro drivers.
It's fascinating how these could overlap, isn't it? An alt season kicking off just as a new traditional bull market finds its footing. That could be a really dynamic period.
And that AI narrative you mentioned, it's a perfect example of a connecting thread, right? Driving hype in crypto and fundamental growth in traditional tech stocks.
Absolutely. And those macro factors Basinger talked about, inflation, rates, QT versus QE, they don't just affect stocks or crypto in isolation, they affect both.
Right. Higher inflation could make certain crypto assets seem attractive as hedges, maybe,
Yeah.
while also pushing investors towards value stocks traditionally.
It's all interconnected. Bitcoin's technicals, market sentiment, liquidity, they all swim in that same macro ocean. And as Y-charts implied, leadership can change. What worked in the last cycle might not work in the next. Investors might need to be more tactical.
So it really feels like 2025 could be a pivotal year, potentially offering opportunities but demanding flexibility across the board.
I think so. This idea of a crypto alt season converging with a new, potentially different kind of traditional bull market, it's exciting, but yeah, it carries risks too. Understanding the cycles, the narratives, the potential leadership shifts, that's going to be key.
So wrapping up this deep dive, maybe the final question for you, the listener, is this. With all this potential change and volatility possibly ahead in 2025, how are you going to adapt?
Yeah, how will you position yourself to try and catch these trends, whether in crypto or traditional markets, while still managing the risks?
It feels like a time for active engagement, doesn't it? Not just sitting back, but really thinking about how the story's evolving and what it means for your own approach. Definitely something to mull over.